Good day. John and I welcome you to our session titled Responsible Investing, Follow the Smart Money. This session builds on 2 years of engaging with you on ESG matters at Investment Insights. Today, we plan to update you in terms of where we are along this journey and to also unpack some questions which our clients have asked. This is important to you in order for you to better navigate your way around our solutions in this space, and it's also important in terms of aiding you in your conversations with your clients. The first question I've got for you, John, is there a difference between responsible investing and ESG? Secondly, what do we practice as Old Mutual Investment Group? And lastly, what differentiates us with so many asset managers participating in this space?
Thanks, Gontse. So I think just maybe to start with some of the definitional stuff. Responsible investing, as you know, is a voluntary commitment to integrate long-term sustainability issues into investment decision-making processes as well as stewardship. I think what's interesting about the term sustainability is it's quite broad. The industry has adopted the acronym ESG to sort of basically cover the sustainability space. As you know, ESG stands for environmental, social, and governance. So in effect, if you think about ESG investing, it's really just the subject matter that is the focus of responsible investing. So when we think about ESG issues, we think of environmental issues such as perhaps climate change, pollution, and the like. Similarly, when we think of social issues, we could think of employee safety, product safety, etc. And then governance, obviously we know the governance issues that are out there in the market. So ESG as a acronym is really something that is embedded into the term responsible investing. Your second question was really focusing on, what does Old Mutual do? We have a very transparent and publicly available responsible investing policy. It's a journey that we've been on for the last decade. It's deeply integrated into everything we do. As a house, we've made a commitment to systematically integrate long-term sustainability concerns into the way we invest, irrespective of asset class, strategy, or even geographic focus. And you'll see that consistently right across what we do as an organization. So, people ask, what does Old Mutual do? Well, we are committed to long-term responsible investing, basically directing capital in a way that is actively seeking returns, but is also intentionally aiming towards building resilience into both society and the environment. So your last question is around, what makes us different? I think, to respond to that, I think the first thing is that we've been on this journey for a long time. It's deeply integrated into who we are as a brand. And so you'll see the messaging and the positioning and the activity of our organization in terms of what we do quite consistently reflected in our practices as a listed corporate, as an asset owner, as well as an investment manager. I think additionally, we've invested a hell of a lot of time and energy into this over the last decade. At last count, we had 12 full-time sustainability professionals working inside of our respective investment capabilities, making sure that the way we consider ESG issues is actually embedded into the investment processes. So we've invested in the resources, the skills, and the capacity to make that happen. Perhaps the most proud of, in terms of what makes us different, is the fact that we've actually, I think, gone beyond just retrofitting sustainability issues into pre-existing investment process. And I think most asset managers out there will tell you that responsible investing is what they do, i.e. they have retrofitted ESG into their existing product. I think what's unique about us is that we've actually deeply understood where the opportunity sits around sustainability. And we've actually been able to innovate and bring product to the market that allows our clients to participate in this long-term sustainability trend. So, what's unique there is the innovation. So product that gives clients exposure to the long-term sustainability thematic. And then perhaps the last thing, and it kind of connects to the first point in terms of this is sort of deeply embedded to who we are as an organization, is the way we're showing up, particularly in the listed market and more broadly from a stewardship perspective. So you're starting to see our organization being a lot more vocal on long-term systemic risk issues in terms of our engagements with companies and in terms of championing for change more broadly within the market.
Thank you.
Yeah, so maybe just to flip it back to you and just to sort of pick up this kind of theme that I've engaged with quite consistently over the years, particularly with the advisor market as well as portfolio managers. There's a really strong perception out there that if you pursue an investment strategy that incorporates long-term sustainability concerns, that it automatically translates into a return sacrifice. How would you respond to that?
John, using our emerging markets ESG index fund, that certainly isn't the case. In a comparison between our fund and the vanilla MSCI Emerging Markets Index, over a period from 2007 to 2009, there's a marginal differential between the two funds from a return perspective in favor of our fund. Extending that comparison over the period 2010 to 2020, that differential becomes more pronounced. This is important because it shows that over time, the differential grows. So it's consistent and dependable. As an example, over a 13-year period leading up to 2020, the actual difference between the two was 63% more returns delivered by our fund. So it's significant. I think it's also important to balance it by saying going this route means you can get market-related returns, which is what the index, the vanilla index, would deliver. But you also, in this case, in emerging markets, have the opportunity to outperform. And I think that's the case with the Emerging Markets Fund, because emerging markets, by their nature, the number of companies that are in that space are different in terms of where they are along the ESG curve. Some of them are really good at dealing with ESG issues and reporting on them, while others are not. And we found that the ESG scores, those that score highly, that's a proxy for higher quality companies. So you're able to get that differentiation more, I would say, in emerging markets as you would be able to in global markets.
Yeah.
I think other reasons that underpin why you can get better returns from these solutions are things like transparency. Companies that score highly from an ESG perspective are transparent and are also accountable to others, which means they can be a lot less reckless or to be a law unto themselves. And I think it's also important to consider that apart from the returns that these index solutions provide, they also have the added benefit of being able to provide benefits in terms of risk management, typically suffering less poor performance in downturns and providing more returns in upturns. And I think that, together with the fact that they are priced quite competitively, makes them a compelling proposition for clients.
Yeah, maybe just to add to that, I mean, one of the things I always say when we first started talking about these ESG indices is this idea that, if you offered somebody the opportunity, to get the same returns with a comparable level of risk, but end it by holding a basket of companies that's measurably better for the planet, the question simply is well, why wouldn't you? And, 30 billion rand of assets into these indices, I think we're getting a strong signal from the market that there is support for this style of investing.
Definitely, John. If I can perhaps move on to my next question for you. Responsible investing has brought with it new data sets. I've always been interested to find out, have these added any value over and above the traditional metrics that we use in asset management? And the follow-up question to that is, us as Old Mutual Investment Group, which data sets do we use? And why do we prefer these over others that also exist in the market?
So maybe just to start to sort of do an environmental scan of the sort of broad market ecosystem, I guess in the first instance, what we're seeing is changes to the broad market. So we've seen standards being published by the likes of, SASB and the GRI. We've also seen exchanges around the world making it a requirement for listed companies to publish sustainability type data. We've also seen an increasing number of listed companies starting to audit and assure the data that's published there. So what that's done is it's brought a lot of ESG information to the surface, and obviously, the investment industry is all about information and how you can leverage information to get better insights to drive your return signature. So what that means is we have a lot of ESG data that's out there, but I'll just say this: not all ESG data is the same. So there is some data that is available that might be binary in nature. Does a company have a sustainability policy or a governance policy or a child labor policy? And the answer may there simply be yes or no. You may also have some data points that speak specifically to operational efficiency issues. What is the kiloliters of water used per unit of revenue? What is the carbon footprint of the operation? So actual operational type data. And then you've got information that is published from entities that I would call sort of rating agencies who provide what would be equivalent to sort of a bond rating or a risk rating. So typically they are represented in a letter score, say from AAA to CCC. And these kinds of ratings, if you like, will look at, the quality of the company's management response to the sustainability issues that are pertinent to its industry. And there is a plethora of ESG data that's out there. I mean, I've seen probably over 15 different service providers in the last sort of 5 years come and go, folks that have tried to make a go at producing data. But I would say that there are a couple of service providers out there that have really sort of applied their minds to the thesis of sustainability, this idea that it's a macro thematic trend, that companies that can get ahead of this relative to their peers will show a whole number of interesting features like low cost of capital, better resource efficiency, lower staff turnover, better innovation, stronger R&D, and relative to their peers in the same industry that aren't responding, typically show stronger, longer competitive advantage, and therefore better returns in the market. So there's a thesis out there that says sustainable companies will outperform, and obviously you've got to backfill that thesis with the right data points. So not all ESG data providers are telling you the same thing, firstly, and the methodologies that they use are often not consistent. And that was quite well evidenced in a paper that was published recently by Professor Dimson from the London School of Economics, where they show the very low correlation that exists between ESG data providers. And what he points at is that often the methodologies that are used, the data that is being collected, the weightings that rating agencies may use within sectors also varies. And so as a consequence, you get this sort of lack of correlation between different data providers. That doesn't mean that there's no value in the information, all right? I guess what I would say is that choosing the right data provider is key. That much we know. And so we've done over the last 10 or 8 years, I would say, due diligences on pretty much every single of the main ESG data providers out there, and we've settled on one, and I'll come to answering that shortly. But firstly, just to get to the question around returns, I don't think blindly following an ESG strategy automatically equates to better returns. I think one has to be very sort of skeptical and have a deep understanding around what the data is telling you. And I think if used alongside financial information and strategic macro-thematic information, one can use this data to be additive to your returns seeking activity. So one has to be quite sort of skeptical and careful on that. So we as a house have applied our minds quite carefully to that. We have partnered with MSCI over time as our main ESG data provider. 3 years ago, we did take a view that we think the future lies in proprietary data sets. So we've invested a hell of a lot of time in pulling apart the data we are receiving and recompiling it in a way that we believe works best given our view on the thesis around sustainability. And I think perhaps that's the future around this kind of ESG data. The last thing I would say from a data perspective is that the field is changing quite rapidly. So we're starting to see a lot more big data analytics, a lot more AI being employed from a sentiment perspective. I recently looked at a data set from an outfit called True Value Labs that have got a sort of dynamic materiality sort of signal based on market sentiment around ESG issues, which is very interesting to look at. I recently came across a satellite-based big data sustainability data provider that's also providing incredibly real-time, high-quality insights. And so, yeah, I think as awareness around the business case and as awareness grows around this big transition that's happening in the market towards a low-carbon, resource-efficient, and socially inclusive growth path, I think harnessing these data sets will become increasingly important from a return-seeking perspective.
Great. And maybe just to go back to our specific data sets that we use?
Yeah, so we use MSCI, but as I said earlier, we are leveraging that information in a proprietary way. So we're not just taking it off the shelf and plugging it in. We're using it in very specific ways based on the strategies that we're employing. So in the fundamental space, we use it in a particular way. In our systematic strategies, we use it in a particular way. In our indexation strategy, it's used in a particular way. So, and from our perspective, we think on a going forward basis, building something that's proprietary based on our own industry insights is where the future lies.
Certainly agree with that.
Great. So, Gontse, coming back to you around, this question of innovation and building products. We've heard about return signature that exists for ESG strategies, perhaps at the global market and the emerging market basis. There's a lot of commentary that perhaps the SA market is too narrow, and that a lot of the pure play sustainability opportunities, so low carbon, resource efficiency and the like, really only exist in the private market space. Can you speak to us a little bit about, is it possible to implement a long-term sustainability or ESG strategy in the SA market? Is the market not just too narrow? And then the second part is, how can retail clients broadly implement a sustainability or ESG strategy, if you like, in their portfolios?
John, I believe it is possible to do so. And in order to answer this question, I will first take you through how we do it, and then also shed some light on why we think it adds value, and then I'll go into how clients are able to capture ESG. In terms of how we do it, I think the starting point is to note that the investment philosophy for our ESG equity fund, which is a perfect example to use, is firstly to deliver on the two ESG objectives, being to have a reduced carbon intensity and to also hold a group of companies that score higher in terms of their ESG scores. Then the second objective is to then hold your traditional companies that are fundamentally sound, which you would hold in any other portfolio. And I think that's an important distinction because things work the other way around in most funds. And lastly is to manage for risk while doing all of that. I think it's also important to note that we've chosen the capped SWIX as a benchmark. So everything that we do in this fund, we do relative to the benchmark. So in terms of ESG scores, we try to achieve at least 20% higher ESG rating relative to the benchmark. And also in terms of reducing the carbon intensity, we try to achieve at least 40% less than the benchmark. Now, this is a great example of how we're actually implementing it effectively in the local market. Why do we believe this adds value? We've already mentioned that ESG scores are a proxy for high quality companies. Another point is the fact that companies that score high from an ESG perspective are normally long-term players as opposed to being focused on short-term gains. If you take that together with the fact that the fund has a tilt towards lower carbon intensity, when you put all those things together, for me, you've got a new or added mechanism in terms of evaluating companies, which are your ESG scores. And what that does is it helps you identify the higher quality companies, and those higher quality companies are around for the long term. Those points together for me make a great proposition for clients because clients are normally investing for the long term. So that works very well. In terms of how clients are capturing ESG opportunities into their portfolios, we see this take place in three main ways. The first one is by investing in our fixed interest fund range. And there they're able to invest directly into projects that have a positive social impact. And the mechanism for that is really by the lending that we do from a fixed interest perspective to SOEs, as well as other parastatals that carry out these infrastructure projects. I think the other important piece or the key value proposition in that space is to secure your income while having a positive social impact. I think the other key consideration in that space or part of the value proposition that's important is the stewardship piece. A number of years ago, we stopped extending credit to certain SOEs because we felt they needed to improve governance internally. It was highly publicized, but I'm very happy to say that it was resolved by us working with them in order to improve their governance and then resume the lending. So that's the first way that they can capture it. And obviously with this, the market being the way it is this year, we've seen quite strong support for those solutions. The second way would be by investing in companies that have higher ESG scores relative to their peers. And this we see mainly in our ESG index fund range. And the value proposition here is a simple one. To get better or market-related returns while having a more positive ESG impact. And then the last way that we see this is by negative screening, which is faith-based. And we see this mostly in our Sharia fund range. And here the value proposition really is to obtain the returns that a client needs, but while embracing their faith. The important thing, though, that we've seen is this is also a good option for clients that want certain sectors or companies excluded altogether. And a good example of this would be weapons manufacturers. So those people that have a high conviction on certain sectors as well as companies use the fund. We've also seen that our ESG fund range as well as the Sharia fund range have garnered support from your younger age groups. And we've also seen that the Sharia fund range, which initially people would have thought only people that are looking for a faith-based option would go there, is actually supported by people who prefer it because of its exclusionary basis. And they see it as a safe haven because of how it's put together.
Great, thanks, Gontse. Well, maybe just some closing comments from my side. I mean, I guess the two main takeouts that I would sort of put on the table from today's conversation. The first is that, the macro thematic trend around sustainability is real and it's happening. This transition that is occurring globally in the economy, driven perhaps right now as a consequence of a lot of the stimulus that's in the global economy, is hastening, I think, this transition to an economy that's centered around low carbon, resource efficient, and socially inclusive. And so capturing insights around this transition really requires, and this is my second point, a deep understanding of the data and the insights, and really just to land that, responsible investing 2.0 is really about innovation. It's about bringing to market product that actually captures the opportunity set of this transition. So, those would be my sort of two main takeouts from today's conversation.
Yeah, in closing for me, John, I agree with you. I feel that we are committed to responsible investing and we continue to innovate in terms of our offerings. It's encouraging to see that clients are joining us on this journey, and they're doing so by choosing to support those ESG solutions that are aligned to their investment needs as well as their personal preferences. And this proves to me that clients, first of all, buy into responsible investing as a concept, they understand the different value propositions across our range, and that they trust us to deliver on them. Thank you for joining us on this session. I encourage you to go onto the virtual platform and have a look at the various collateral and information that we've included. You can download, you can read and go through it. I'd also like to encourage you to reach out to myself. My contact details are also available on the platform should you require any further information or engagement on this subject.